Good evening, ladies and gentlemen. Welcome to a Sunday night live stream where I want to share with you some of the fixations I have on stocks that I'm highly attracted to. And it's very hard to wrap my mind around exactly where they're going to go in the near term with the interest raising environment. And a lot of this is going to have to do with the Canadian real estate market. Obviously, it's the title of this video. There's just so much I want to talk about from what I'm seeing, just obviously living in the greater Toronto area with real estate specifically. But before we get into that topic, I first and foremost just want to take a broad view of the market, kind of what's going to be going on this week, stocks that I'm going to be paying attention to, big news that we're going to see out of Tesla and a lot of other companies. But first and foremost, I think my favorite thing right now, it's like the oracle to me, and that's got to be the US dollar. US dollar always kind of gives us insight into what the market does. If you guys don't follow the value of the US dollar, and essentially what the stock market does, the S&P 500, it's the exact opposite of what the US dollar does. And right now, kind of coming into the end of the weekend here, we're just starting to get some more values out of the USD, and it's been relatively flat. But again, this is like my little oracle prediction thing, because when the US dollar goes up, the market goes down. When the market goes down, the US dollar goes up. It's just vice versa. I don't know why this became correlated, but it's heavily correlated. And taking a look at pre-market here, as the US dollar has been flat, we're mostly seeing the S&P 500, Dow, everything's just been kind of bouncing around flat. I have no idea what the market's going to do in open tomorrow, but I find it highly interesting that the fear and greed index is currently at greed. I don't think this has been updated for the recent news that we got out of last week, because I don't think many investors, after the news that we heard about inflation, I don't think there's a lot of bullishness going on in the market here. I think that's why we're starting to see this cool period, because obviously, inflation, I got this horribly wrong. I really thought inflation was completely dead coming through the summer of last year, but these numbers in the US are just way too high. If it stays at these kind of levels, you're looking at a 4% inflation rate, which is nowhere near close to the federal fund rate they want, around 2% or whatever the hell. So I think there's going to be some continued pain if the Fed decides to see, if the data in February comes out worse and the Fed keeps hiking the rates, which people are expecting it to get over 5%. However, there's some caveats to this, because on the Canadian side of the border, it seems to be a completely different story, right? In Canada, I don't know if we're going to see a divergence at this point, because Canada typically is the bellwether to what the US is going to do, because our, inflation data, our interest rate hikes come out before, Jerome Powell and the Federal Reserve release theirs. And with the current inflation numbers in Canada, I just don't see them raising rates. I mean, inflation here has cooled off pretty dramatically when you look at the last 6 months, nothing comparable to the US. So I don't know what the hell's going to happen, but it's still a completely turmoiled market because of this. And until this is over, it's just going to be the continued headlines. Meet Kevin, all these guys are going to talk about till their faces are blue. I try not to focus on it too much, rather just look for deals and companies. But unfortunately, when it comes to REITs that we're going to be talking about, the interest rates are something that you're going to have to pay attention to. But before REITs, obviously, let's talk about some growth stocks here. Tesla. Tesla is one that I can't help but watch religiously. This was a huge part of my portfolio gains back in the day. And I just want to talk about some of the stuff coming out with this, because I think it's going to be a real interesting week, considering the crazy rally Tesla's had over the last, since the beginning of the year, really. But if you guys don't know, I'd highly recommend watching it, because usually the investor days are highly interesting when it comes to Tesla. And this is supposed to be a big one on Wednesday, coming up on March 1st. But I think it's interesting because Tesla's likely to reveal the HW 4.0, the latest hardware for driver assistance, including better chips, more cameras, and apparently the return of radar, which is something they've obviously Elon kind of completely pivoted away from, right? But Elon Musk said that all Tesla EVs were hardware ready for full self-driving in 2016. And I got nothing against Tesla. It's a hard stock for valuation to wrap your mind around, but a lot of people ask me why I haven't bought it back. And I can't bring myself to buy this stock until self-driving or some other aspect of their business comes into fruition. I held Tesla since 2019, and 2019 full self-driving was going to be ready at the end of the year. 2020, it's going to be ready at the end of the year. 2021, all the way till now, it's going to be ready. I can't wrap my head around the auto valuations without these extra perks. So I'm always just watching and waiting, and I don't mind paying a premium in the future for this stock. I just don't want to be caught in a hype cycle of just, fanboys, because I try and look at two sides of the coin with this company. And again, I think if you're younger, there's nothing wrong with buying growth stocks like this. It's just, for me personally, I don't know. I just hate feeling like I've been lied to when self-driving was my pure fascination with this company. So I think the rollout for that's going to take a lot longer than most people initially anticipated. But that's not the other negatives here. There's other problems, meanwhile, Tesla's price cuts in early January gave initial burst of orders worldwide. You remember, like, they cut the price and get Teslas now with tax credit like under 40 grand. But aside from the Model Y in the US, Tesla demand appears to be waning against obviously inventories are growing. So I think there's some concerns in the EV market because China's kind of in this recession and they're seeing a huge slump starting to go in EV sales, which I think is going to hurt Baidu. Or is it Baidu? What's the one that Charlie Munger loves that he made all his money on instead of Tesla? So these are just things that you're going to want to watch because I think these are the signs of the recessionary environment, the insane volatility, and companies that seem so resilient and long-term will continue to be resilient. I'm not long-term bearish on this company by any metric. And most companies I'm not bearish on, but you can't help but start seeing the fallacies, the flaws, and the issues with the full bull thesis these people have had and how they're changing their bull thesis to say, well, I'm just buying it for the auto business now and not just the self-driving. You just keep hearing the stories change. Same with crypto and Bitcoin. It's just everyone's narrative isn't what it was when I was more interested in these kind of companies. Yeah, buy Tesla. 50-75 is juicy. Honestly, anything under $100, I think just for the auto business would be a lot more favorable. And then you hope the cherry on top is, robotic self-driving. But until that stuff's commercialized, you are taking on some speculative risk, which is better for a younger investor. For me at my age, the wealth I have, I'm trying to be a little bit more prudent and cautious with buying growth stocks. However, let's kind of get into the discussion that I want to get into here, which is Canadian real estate, Canadian REITs, collecting dividends. I've had this kind of constant debate in my head lately of, do I want to buy REITs back? Because I sold them toward the end of last year to top up my tax advantage accounts. And I have really lacking in real estate exposure, but I have fears. There's still a lot of fears in the real estate market here. But it's either that or I was going to cost average into the Vanguard, Canadian, basically S&P version of the S&P 500. It's VCE. It's just the total market kind of index here in Canada. But I'm kind of torn between those two investments. Do I want to keep buying REITs or do I want to buy the broader market for the time being? Because what I see in the real estate market, I live near Markham, Richmond Hill. I'm constantly looking at real estate deals, rental prices, and there's a lot going on, like a stupid amount of stuff going on. So firstly, I want to point out this big problem in the major cities. Rents are still insanely high. Toronto, Vancouver, rents are insane. I mean, like a decent, comfortable living now in anywhere near Toronto or the GTA, you're going to be spending around $3,000 a month. Now, if you're cheap, if you're frugal, nothing wrong with a basement apartment, renting off your parents cheap. I mean, by all means, it's the best option I think any millennial currently has because you can't really afford to buy $1 million comfortable property, and paying $3,000 a month is just, it's a lot. I mean, it's pretty exuberant if you're not locked in because we're a rent controlled place. And with rent control, the government mandates you can only raise it by like literally a percentage point every year unless you kick those tenants out. And when you kick those tenants out, you can get market rate demand for whatever that is. But anyways, let's talk about this because it really relates to Canadian apartment properties. This has been one of my most fascinating REITs to follow because it really resembles what's going on in the broader Canadian rental market. And this REIT, most people don't find appealing because the dividend yield's only around 3%, but it has offered favorable growth over the history of this company. And the reason that I find it so fascinating is because when we get into it, there's a few concerns that I have and a few fascinations. The fascinations is the fact that these companies are continuing to grow in a volatile market. Now, obviously owning all these properties, all these rental units, seeing turnover, getting new tenants, what you're really going to start to notice with this is this massive explosion right here of just they're able to collect these crazy rents. So their cash flow is going to continue to grow at an incredible rate on any turnover tenants, any new tenants. They don't even have to buy new properties. They just really have to turn over the tenants they have in the major metropolis areas where they own, like Toronto, GTA. They own all over Canada, but I think 30 or 40% of their exposure is in Ontario. So, I mean, this is going to continue. This company is going to continue to make money. However, in the long term, there are concerns because their average rated interest rate is around, I think, 2 to 2.5%. And that's never going to remain the same. I mean, over the next 5 years, there's no way rates are going back to zero. It's just not going to happen. So wherever they nominalize out over time, because I think their average, mortgage rate is for 5 years. So over the next 3 to 5 years, as those mortgages turn over, we're going to obviously see them paying a lot more to float these properties. Luckily, their debt to asset ratio is very reasonable, but at the same time, like it's hard to buy new properties or do anything where you're paying 5 to 6% on interest rates. So that's going to be a bit of a concern, but it seems to be cushioned by this increase in the demand for rent. So it's something that I'm just watching in fascination because I'm like, this company, I don't know how to run the math on it correctly because I don't know at what rate they're going to be able to increase rental prices. Because if we actually take a look, Does it show me here? I think I might have passed it, but it shows us the average rent on this company is insanely low. I think it's back toward the top here. If we take a look at operating revenues, net payout, I mean, the payout ratio is low, blah, blah, blah. I think they're like, because their average rated rent across their whole portfolio right now is insane. It's like $1,300. I think it's here. Consistently strong occupancy and rising AMR. So yeah, I think this is their average monthly rents are like, I think it's just around 1,300. I was looking at these stats before. I should have left them up, but that's so low. I'm like, why is their average income only 1,300 a month across their portfolio? It should be astronomically higher than that. So I'm really confident over time this REIT, even in the interest raising environment, should be cushioned against much of the blow. Here they're showing the estimated current market interest rates that they're paying. So no more than 15% of their total mortgages come due in any given year. But again, over time, it doesn't matter because, I guess they got some long dated, because I guess, what do we got? 2025, 10% comes due. So 2025 to 2027, 30% of their portfolio is going to come due for mortgage rates. But man, I would really take some time and analyze this stuff because it's hard not to be bullish in the Canadian real estate market. As much as I want it to crash miserably, in my area where I look at homes that are getting listed, they are selling in these really hot areas in Markham within a week of being listed, still above asking like prices. And I'm just fascinated that how are people affording this crap? These people that live in these areas have to be so absurdly wealthy to handle this mortgage market because the average cost of real estate in Markham is like $1.5 million, $2 million at like the minimum. So could you imagine like a 5% interest rate on $1 million, just paying 50 grand a year in interest before principal, before insurance and taxes, maintenance and utilities and blah, blah, blah. Like who is buying this stuff? Because it certainly ain't me or you. But nonetheless, the next aspect of the real estate market that I find fascinating, and that is the shopping malls and the lack of available area to build real estate. So in Markham, again, because I live here, I travel around here a lot. I go to the Markville Mall a lot. If you guys know the area, shout out. I love the Markville Mall a lot, but there's something happening here, and that is that they're going to take the entire parking lot and basically construct condos. Now, this is something we talk about with REITs like RioCan and Smart Centers, but this is the only place to build new real estate because of the insane lack of area of development when it comes to Greenbelt rules. Canada is really restricted in Ontario for building new real estate. If you went out to Stouffville, if you go out to the edge of like, let me just pull up a map real quick. So let's just go Ontario map. Let me just see if I can kind of give you guys an example of this real quick, because I just don't think people appreciate how messed up our real estate market is here. So we zoom way in. Let's go to Toronto here. Oh, sorry, guys. This is really touching my Mac mouse. So if we come up to here, guys, this is the Greenbelt, right? So we have all this stuff here. Toronto, Markham, Vaughan, Brampton, Mississauga. This is the only areas at which anyone can build real estate. Nobody can build real estate out here. You see all this farmland, all this incredible amount of land, considering we're a little tiny dot, literally in the middle of forest. All of Ontario is forest. All this stuff up here, no development, all of it. But yet we have Greenbelt limits protecting the land from development. Now, you can be for or against this. I'm obviously like on the barrier. I don't think we need to destroy the Greenbelt, but there's too much land. Newmarket, Aurora, Stouffville's right over here. There's no development because they're not allowed to because of bylaws. I mean, you could build so much land right here and it could completely solve the real estate problem, but the government will never allow it. So the only opportunity in new real estate is in malls, because malls are the only place where there's so much damn land. Like look at Costco. Costco is making a plan right now to build residential units above the Costco. They're like, hey, why don't we just build condos above this massive shopping center? Because there's billions of dollars of value in it. So this is something I'm really kind of fixated on because there's just so few companies right now that have that capability. Like in the US, there's so many development REITs. In Canada, there's no development REITs because there's no money in it. There's no one that can actually afford to buy land and build new. So why not take the people that own the expensive land, that have the liquidity and have the value already locked in the land to just build a condo above it? And that's what we're seeing with companies like RioCan. That's what we're seeing with companies like Smart Centers. Now, if I had to compare the two, I like RioCan a lot more than I like Smart Centers, just because I think RioCan coming out of the pandemic really stabilized their balance sheet. They cut the dividend. They're in a really good, healthy position. They just raised the dividend again. So, I mean, if I had to pick one or the other, I like them both. I think you can own them both and be fine, but just take a look at this stuff. This is the kind of mall development we're seeing from RioCan. They have all this open land and they're like, well, we can't build anywhere else. So why don't we just make tens of billions by constructing these, thousands of units and office and new retail space, because this is the new way of living, right? Like RioCan has basically made it so you don't have to ever leave a condo building. They're going to build malls on the bottom, condos on the top with office in between. So you got your work life, your living life, and your shopping life all in one building. That's the future of Toronto. And you take a look at these properties, they're the most premier properties in Toronto. The 11 Yorkville, I don't know if you've ever seen this property. It's completely sold out. All the condos that I'm looking at that are pre-construction anywhere in the GTA close to Toronto are mostly sold out. And you see that in RioCan's, presentations here. It's nuts. Most of these aren't going to be done until 2025, and they're almost completely sold out across the board. There's no way of doubting that, that the real estate market is still not excessively strong in the major metropolis areas. So I can't help but be massively fixated and fascinated by this. And considering I'm not buying real estate in this current moment, to not have this kind of exposure to it almost irks my soul. But the thing I want to see still is, how it's hard to run the math on those interest raising hikes and how bad that can affect this development in the long run and what it's doing. But as far as I can tell on the recent earnings from all of last year, all these companies are growing. They're all doing very well. So there's one more sector that I don't understand. I'm trying to understand it better. This is more like tangible to me because I can go out, I can feel it. I've been to the Well downtown Toronto with RioCan. I've been at 11 Yorkville. I drive by all this stuff all the time. But what I don't drive by is obviously distribution centers, warehousing, logistics. So there's one REIT that I use as like the primary factor for the entire logistics center because it's one of the strongest logistic REITs in the world, and that's got to be Stag Industrial. They have very minimal debt. I think they're like 30 or 40% of their entire $6 billion value is like, its liabilities. They're very well. Their balance sheet's one of the best in the real estate market. It's been one of the best growth REITs. But funny enough, my favorite counterparty to this, and the one REIT that I watch here in Canada, is Granite Real Estate Investment Trust, which actually has better performance than Stag Industrial. And it pays roughly it always pays around the same dividend. And these things have been high flying. We do not have Granite REIT's earnings out yet. And a lot of people thought logistics were dead after Amazon cut the development of new logistics centers, but we're not really seeing that in Stag's earnings. So when it comes to Granite, so my three REITs, the three that I fixate on by far the most is Cap REIT, RioCan, and Granite Real Estate Investment Trust. If I had to comprise a portfolio tomorrow of REITs, these would be the only three that I would personally think I'd need in a portfolio, excluding chasing super high yield. I'm not like a high yield chaser. I told you guys, I don't focus on dividends as the primary idea of my portfolio. It's long-term growth. It's back to the old school Kevin O'Leary days, right? When he used to talk about his mother saying like, you shouldn't ever buy an asset that doesn't pay you while you wait for a return. And I want to get returns out of these REITs. So I'm hoping that, building a comprised portfolio of what I think are the best ones will grow over long periods of time. However, let's just take a look at Stag, because what the problem in the real estate market is right now is there is a correction. And when you're talking about billions of dollars of real estate, correcting by 10%. I think it was like 5 or 10% in Toronto last year. Across the GTA, it's been a lot higher. Durham region saw like 30% corrections. That really affects the balance sheets when you look at EPS numbers. And this is where things get skewed for people analyzing this stuff. Because if you look at EPS numbers on Stag, the numbers look like shit. I mean, you take a look at the earnings down at the bottom here. I don't know if I can zoom in so you guys can see this. So if you just looked at the net income per share, it dropped down to $1 from $1.15 this time last year. So you'd automatically presume this company's losing money. However, that's not the case. The rental income went from $559 million to what? $654 million just from rental income. The rental income went up by $100 million. That's insane. Like, it's nuts, right? Other income went up by, another couple $100 million. But when we break down the general administrative, the depreciation and amortization and some of the expenses, we're seeing increases. So general and administrative went up quite a little bit by like 20 million there. But what we're really seeing is amortization costs go up. So if you take a look at this amortization cost here, guys, this is basically them writing down the value of their assets. So unfortunately, and the only way for like newbies to understand this is, let's presume you buy a car, and the day you drive that $40,000 car off the lot, it immediately loses like 10, 20, 30% of its value, depending on the vehicle. Even though that car is still going to take you to work every day, it's still going to produce the same cash flow, the value of that asset immediately went down. But what REITs have the capability of doing is writing that off against their income, so they don't have to pay tax on it. And it really affects the bottom line EPS numbers. So even if you can take that into consideration over the correcting real estate market, these REITs are still posting incredible numbers. They're still doing very well in an interest raising environment. So it's hard not to be bullish on these companies for now. Like I said, when you talk about fundamentals of the economy, I'm constantly looking at savings rates. They're all going up when or saving rates are going down, credit card rates are going up. People are struggling if you're on the lower spectrum of income. And I don't know what that's going to do with the real estate markets, what it's going to do with the long-term stock market. It's very hard to gauge out when the jobs market is so damn strong. We're in this kind of tailwind of, are we heading for a soft landing, or are we going to see a major impact? It's going to cause the stock market to crash a lot. And then all of a sudden unemployment will spike. And then immediately the Fed will pivot and lower interest rates. It's historically what has happened in most prior crashes. The pandemic, 2008, the dot-com bubble, 1980s, all of those all followed a similar kind of fashion. This seems different. I'm hoping it's different. I'd like to see a soft landing, less people get hurt, but who the hell really knows, right? But putting that aside, guys, taking a look at my portfolio where it sits today, you guys have seen this many of times. My portfolio is down like $10,000+. It's kind of funny at scale how you start getting used to this stuff. I mean, go back to my channel, 2019. I barely had $100,000, so we've come quite a long way in the last 3 or 4 years. But now these days I've stabilized. I've become an old man. A lot of people call me this old man investor because I focus on my index funds these days, but it takes the stress out of my back of not knowing what's going to happen tomorrow. This isn't a market I've experienced. So I've obviously made some shifts here, guys, but let's take a look at some of your comments, questions. And if you guys obviously want to support the channel, I've got some links down below. Portfolio spreadsheet. If you like my spreadsheets, you can track your finances, so much more in between. Nice sweater, looks sharp. Thanks, brother. I should be wearing a suit, but Sundays, weekends, I tend to wear whatever. You're wrong on development rates. DRM is exactly this. DRM, let me look that up real quick. So when it comes to the development rates, I think it really depends. Oh yeah, Dream Unlimited Corp. Yeah, no, obviously, but look at the correction it's had. So this is what I'm saying by, like, in this kind of a market, I think they're going to have a hell of a time making money. And you're kind of seeing it because of the insane cost of buying new development properties. Look at this correction in this company here. This historically is usually things we don't want to see in stocks when you get this wicked 50% crash. And like I said, development, I think, is going to struggle moving forward. There's just no way. I don't know about this REIT or what properties they own, but any new development, go out and try and develop a property today. Do it. Just go run the math on it. It's effing nuts. Nobody in Ontario is building new properties from scratch, buying land and building. It's the dumbest thing you'll ever do. My dad works he does basically foundations in homes, and the loopholes people are working to try and fix old broken houses. Like, they jack homes up to fix the foundation and to avoid the red tape. This guy that they were working with, he didn't want to have to deal with it. Would have cost hundreds of thousands of dollars for him to actually tear the whole house down and rebuild it. So what they did is they tore off 3 walls, built 3 brand new walls, and then built a new wall over the old wall. Like, just talk to people in the construction industry. It's nuts. It's completely messed up here. So I would just avoid development. It's just my personal opinion here. But let's continue on. Sorry, I get a little heated about that. It's crazy here. Same concerns for me with REITs, and some areas rent increases are capped. Yeah, that's the rent caps are only if you've been in there. Like, my uncle lives in Toronto. He's got a beautiful condo right on Church and Wellesley, and he's only paying like $1,400 or $1,500 a month for rent. It's honestly jaw-dropping. It's like a 2-bedroom, 1-bath, beautiful condo. It used to be able to see Niagara Falls from their balcony with binoculars until they built all the new high-rises. But he said that he's so good with the owners that they're never going to buy a condo because they'll never get anything that cheap. And the owner's like, I own the building. You guys have been here for like 30 years. Just don't worry about it. So they never raised the rents on them. It's so insane. I'm like, you guys are so lucky. It's kind of a beautiful thing if you've been in and you got good relationships, right? How do they manage squatters who don't pay rent? Hear about those stories all the time. Yeah, it's not a good, Ontario's not a landlord-friendly province. You don't want to be a landlord in Ontario. All the big guys I deal with just say avoid it. I mean, obviously with RioCan, CapREIT, I don't know. From a big scale, multi-billion-dollar corporation level where they've done it already, it's great. From a personal level, there's people that'll go rent. They don't pay rent. It takes 6 months to kick them out. You can't sue them because it costs more to sue them than to get the rent back. It's kind of a terrible place to be a landlord, unfortunately. Love Montreal. I haven't been to Montreal in a while. I should go buy Tesla 5075, back to the Tesla stuff that we were just recently mentioned. So on that note, folks, I hope you enjoy this quick stream of just talking about REITs. Maybe I'll answer this last question here. Why do you buy VOO and not the Canadian equivalent like VFV or ZSP? Is it better because of the exchange rate? No. So really easy. I operate businesses that make US dollars. So I actually get paid in USD. So I try and avoid if you're not going to the US, if you're not spending US dollars, just buy VFE. It's an easy compromise. But for me, I like having US dollars. I like getting paid in US dollars. So I have this kind of mixed income for my business where like some companies will literally pay me US dollars. I get crazy tax breaks on that too, by the way. I'll take those US dollars and I'll invest it in US stocks. So I'll buy the S&P 500 and I like collecting US income because then when I go to the States or I travel, I can pull those dividends out. I can literally just pull it out in my US savings account and I can just spend it in US dollars. I don't think people understand how easy it is to even spend US dollars in Canada. So, I mean, not a big deal. It's just my personal preference, but most Canadians, you don't travel that much. You're not worried about it. Just buy VFE. It's an easy compromise without having to deal with the conversion rates. My father-in-law works in electrical distribution for home builders in Ottawa, and he said things have slowed considerably. So this, again, I guess it's different markets. I don't think things are slowing. Maybe they're slowing for sure. I mean, to some extent, depending on the market. I don't know Ottawa that well, but again, in foundational work, it's nuts. My dad's never been as busy as he is now. So I don't know about the electrical side of it, but from a foundational standpoint, there's endless amounts of work. He needs to retire. He hates doing it. And he doesn't hate doing it, but he wants to retire in the next year or two. Line of credit interest are so high now. Mine's at 12. I don't look at my line of credit anymore. I used to use it, but now I don't. I have zero debt. F debt. This is not a market for debt. It's a market for cash and looking for these investments because they're discounted. But on that note, folks, I definitely appreciate y'all coming out on this Sunday night. Again, if you guys want to support, I highly recommend going to the Patreon page. I do a lot of private content there, and I'm going to give all my patrons some priorities over these live streams when it comes to questions and answers and stuff. But I'll always answer your questions. But I love you guys very much, man. You guys keep me alive. You keep this resilient, and I'm glad I'm still here because most YouTubers aren't. I'm watching the fall of so many YouTubers in this market just fade and disappear, but I'm still here, baby. And I hope you are too. So stay cool, stay awesome, folks. And as always, I'll catch you in the next one. Peace.